While every hedge fund manager was quietly loading up on these four assets before the 2008 collapse, your financial advisor was still recommending a diversified portfolio of the exact stocks that were about to lose half their value. Most people think market crashes are unpredictable, random, unavoidable, but the data tells a completely different story. Every major economic collapse in modern history has followed a pattern. First comes the panic, and everything tied to economic growth gets demolished. Stocks, real estate, commodities, all collapsing at once. But then something fascinating happens. Enormous amounts of capital have to go somewhere. Institutional money managers, pension funds, sovereign wealth funds, they cannot just sit in cash while inflation eats their purchasing power. So they flood into specific assets. Assets with physical scarcity. Assets that produce value regardless of economic conditions. Assets with a track record of surviving every previous catastrophe. That flood of capital is what creates the surge. And the people who position themselves beforehand capture life-changing gains while everyone else is still in shock. These are those four assets. Asset number one is gold mining stocks. Not physical gold sitting in a safe, the actual companies extracting it from the earth. During the Great Depression, while the Dow Jones collapsed nearly 89%, home stake mining gained 474%. Banks were failing everywhere. Unemployment hit 25%. The economy was in ruins. And that single stock quintupled. The mechanism is straightforward. When faith in paper currency erodes, gold demand explodes. But the cost of extracting gold stays relatively flat. So mining company profit margins absolutely blow up. And because of leverage, when gold rises 50%, miners can easily move 150% or more. Less than 2% of investors own these today. Not because they are risky, because Wall Street earns zero commissions helping you buy them. Asset number two is long-term treasury bonds. I know that sounds like something your accountant grandfather would suggest. Stay with me because the numbers are remarkable. During the 2008 financial crisis, while stocks dropped 57%, long-term treasuries returned over 14%. In one single month, November 2008, they gained nearly 15%, while everything else was in free fall. The reason is called flight to quality. When panic sets in, global institutions race toward the safest asset on earth. Demand surges, prices climb. People who already own them collect massive gains. The critical thing most people miss is timing. You must own them before the crisis hits. Once panic is visible on every news screen, the gains have already happened. Asset number three is farmland. This is the one that should stop you cold. Over a 20-year period ending in 2020, farmland returned an average of 11.5% annually, with significantly lower volatility than stocks. During the 2008 recession, it posted positive returns, while the S&P 500 lost more than half its value. The logic is permanent. Nobody is creating new productive land. Population keeps growing. Food demand never disappears. And unlike gold, farmland generates actual cash flow through crop yields. You do not need $500,000 to access this. Farmland REITs trade on the stock market like any other share. You get exposure to the same asset class billionaires are quietly accumulating for less than the price of dinner. Asset number four is consumer staples stocks. These are the companies making toothpaste, soap, groceries, and beer. The unglamorous essentials people buy even when everything else falls apart. During the 2008 crash, the consumer staples sector declined only 28%, while the broader market lost 57%. Walmart actually gained 18% that year. These companies carry pricing power, steady dividends, and earnings that barely flinch during recessions. They will not double overnight. But here is the math that matters. If you lose 57%, you need 132% just to get back to zero. If you only lose 28%, you need 39%. That recovery difference compounds into enormous wealth over time. Now, here is the uncomfortable part. Look at where economic signals currently stand. Credit spreads are moving, corporate debt levels remain historically elevated, consumer credit card balances just hit record highs. I am not predicting a crash. Predictions are worthless. But the same conditions that preceded previous collapses are visibly present right now. The time to own crisis assets is before the crisis, not after. Once it appears on every headline, the repricing has already finished. The opportunity has closed. So, what do you actually do with this? 3 steps. First, open your brokerage account today and look honestly at your portfolio. What percentage of it would benefit from a crash versus collapse under one? If the answer is nearly all collapse, you have a gap to address. Second, research GDX for gold mining exposure, TLT for treasury bonds, farmland REITs with tickers like LAND or FPI, and XLP for the full basket of consumer staples. You do not have to buy anything today, but know exactly what you would buy when you are ready. Third, monitor 3 warning signals weekly: yield curve behavior, corporate credit spreads, and unemployment trends. When 2 or 3 of those simultaneously flash warning signs, you want your defensive positions already in place, not just planned. The market is not one game. It never has been. It is 2 games running simultaneously. The bull market rewards momentum and growth. The crisis rewards scarcity and essentials. Most investors spend their entire lives learning only one of those games. They win during calm years and give everything back during the bad ones. The investors building genuine, lasting wealth know how to play both. This information is not a secret. It is sitting in public historical records going back a century. It just never gets advertised because no one profits from teaching it to you. Now you know it. What you do next is entirely your call.